policies which they have to implement for doing research for the implementation of the newer policies, etc. That's what for they use the earnings out of these investments of endowment funds. They use it for the purpose for which they had been established. Then there are pension funds and all that. These pension funds are also a very popular form of institutional investors. Both an employer and employees can invest in pension funds. The accumulated capital goes towards the purchase of different kinds of securities. Now, there are two kinds of pension funds. One is where the pensioner receives a fixed sum irrespective of how the fund would fare. And the other is where the pensioner receives returns based on the performance of the fund. Apart from these types, commercial banks are also considered as institutional investors. Then the last one is the foreign institutional investor. A foreign institutional investor, which is commonly known as FII, is an investor or investment fund investing into a country outside of the one in which it is registered or headquartered. That means, in a nutshell, the FIIs are the institutions wherever they are registered, they don't invest in that particular country, rather they invest in some other country rather than their home country. FIIs they can include hedge funds, they can include insurance companies, pension funds, investment banks, and mutual funds, or a combination thereof. Each FII or sub-account of the FII has been permitted to invest up to 10% of the equity of any one company, subject to the overall limit of 24% on investment by all FIIs, NRIs and OCBs. See, in simple terms, if I tell you that any FII can invest into the capital of the company only up to 10% of its total paid up capital of the company. And number of FIIs, including NRIs, including overseas corporate bodies, OCBs, all inclusive of them, they cannot invest more than 24% in any particular companies, more than 24% of the paid up capital of the company. However, this 24% limit can be raised to 30% in the case of individual company who have obtained shareholders' approval for the same through the resolution of the shareholders. Then, difference between the investors. What is the difference between institutional investor? I mean, we have all done it, retail and the institutional investor. What is the difference between the two? The basic difference is on the basis of definition. The institutional investor, they don't invest their own money. What they do is they collect money for and on behalf of others. They collect money from others, they pool it up and invest in securities in large volumes on behalf of others' entities. And what is the scope of theirs? They can deal in security of any markets of all kinds, and they can influence the investors, can impact the demand and supply of securities, and can affect the trend or the movement of the price movement of any stock in the securities. Whereas in case of retail investor, he deals in securities via brokerage firms or other facilitators. Specific markets like forward markets are not particularly accessible by retail investors. Retail investors do not possess the kind of influence individually to direct the price movement of any security. Investors' personality traits. You see, on the basis of the personality also, there are different types of investors. And there are 6 types of investors, and some related personality characteristics of these investors are these 6 categories are busy investors, casual investors, cautious investors, emotional investors, informed investors, and technical investors. Let's do it one by one, each one of them. First, busy investors. The busy investors are interested, some might say obsessed, with the markets. They follow the ups and downs of equity, gold, or real estate prices. As a result, they tend to buy and sell frequently, often based on what they see others doing. Normally, what happens, as I had shared earlier also, that it is somewhat more like an active investor. Busy investor or active investor is more or less the same. They at times look at what others are doing, how they are faring, how they are investing. So they get influenced by the trend the market is showing on a particular day or at a particular moment, and they keep themselves very busy, very active with regard to the same. The day traders fall in this type. These active investors can also be high rollers, willing to take a charge on the market volatility rather than sit it out. You see, they think that they are smart enough, they are shrewd enough to outbeat or outclass the volatility in the market rather than sit out quietly and not doing anything like passive investors. They often share personality characteristics with entrepreneurs for whom financial success is a scorecard. You see, normally what happens, an entrepreneur would never sit idle. He would always be willing to grow more and more and more, and try to earn profits at any given point of time. Whatever he sees or looks at things, he would see that he can make money out of it and he can grow his business. So the busy investors have the similar type of characteristics or traits. That is why they are being compared with entrepreneurs as well. Next type of investor is a casual investor. The casual investors are the opposite of the busy investors. Once an investment is made, they tend to let it ride, believing that it will take care of itself. These passive investors tend to trust in the advice of their financial advisors. They are also known as lazy investors. They typically prefer safe investment that have proved their value in the past. Sometimes their laissez-faire, that is laziness, approach to investment is a sign of their optimism that everything will work out well in the end if you just let things take their course. This is based on the old theory. I mean, let time speak for itself and let the time grow your investments. Third is the cautious investments. Cautious investors, as the term goes, tend to be the most risk averse. They don't want to take risk. They're very, very careful about taking the risk, putting financial security first. They take their time when faced with decisions, preferring to weigh all of the options before choosing. Afraid of making mistakes, their pursuit of the perfect decision can mean making no decision at all. They at least are so cautious that they fail to make investments at time and lose good opportunities of investments. This puts them in the passive investor category. Older investors who are more interested in safeguarding their resources and have shorter horizon for recouping losses often fall in this type, and these are the type of investors who normally go in for fixed deposits, or you see, government bonds and all that, municipal bonds or debt instruments, rather than investing in equities market, not taking any sort of risk and keeping their principal intact, with and being satisfied with little return rather than taking any risk. The other type is emotional investors. Again, on the basis of the characteristics, this is another type of investors. These emotional investors are very interesting. They put their heart into their investment decisions, not their head. For example, they are likely to invest in companies because they use and like the firm's products, regardless of the stock's performance, or to hold on to real property in a depressed neighborhood for sentimental reasons. These are the types of investors. You see, just because their father was working in a company, or they had been working in a particular company, or they worked in a particular company, they have been using the products of a particular company, and they have some sort of emotions or sentiments involved with a specific company or stock. They would just invest and stay invested in that company rather than liquidating themselves, even if the stock has outlived its life. They can be blend of active and passive in their approach, eager to make investments. They feel sometimes committed but unwilling to let go of those that have outlived their value. Normally, such investors, in case of properties and all that, are there. Even if a particular area has depleted or has, outlived its life, and there are only negatives in that area now, and no scope of enhancement in the value of that investment, they still would not let it go. They will say, no, we have emotions attached to it because this was a house which was built by my grandfather, and then my father lived it. I took birth in this house and got married and all that. So I'll not sell it off. Such sort of investors are called emotional investors. Then there are informed investors. These informed investors tend to make a well-rounded approach. They are careful to stay up to date, using a variety of sources to fill in their understanding. While confident of their own financial acumen, they also are willing to listen to the advice of experts and to act decisively. The informed investors normally are they can also be called technical investors, because they look at investments and all that technically. They do a lot of research and technical analysis of any stock before investing into it. They study a lot. They study the financials, past and present, as well as they see the future of prospects of that particular stock in which they're going to invest. They do the technical analysis of the stock before investing into it, and they're shrewd, and they also not only believe in their own acumen, they also try and take advice from the experts before investing. Often high achievers in their professional lives, they typically have a strong work ethic and may seek the same sense of control and accomplishment in their investments. These are normally professional investors, and who are, while in their job or in their employment or in their business, while they were professional in their dealing and all that, they same sort of thing they look at or they look for even in their investments, and that is why they are known as professional investors or technical or informed investors. Then technical investors are also share some characteristics with busy investors, but they tend to analyze the numbers and read the pundits rather than reacting to every market move. They may spend a lot of time on their computer screens, but feel that their diligence is rewarded if they spot a trend earlier than others. They are so technical that they would always be clung to the trends. They would look for a particular trend, whether it is upward trend, lower downward trend, or static trend, and all that. And within how much time the trend is changing, and if a trend is outbeating their expectation of the market, or the performance of the stock and all that. They would do so much of technicalities on that they are typically known as technical investors, because their investments are all influenced by technicalities and a stock. Their desire to get an edge on the markets often leads them to buy the latest technology. These active investors are very involved with the management and choice of their investments. You see, investors in context of startups. Nowadays, the startup is a buzzword. When in case of startup, there are different type of investors. These are broadly family, friends, and relatives, angel investors, venture capitalists, and private equity investors. Now, family, friends, and relatives, all of you understand that initial stage when you have a new idea, a startup, you're going to start a new startup and you have a new idea, nobody will come forward and give you or risk his money with you. It is only your very close relative, your parents, your relatives, your friends, those who believe in you and believe in your capacities or in your acumen and knowledge, they only will come forward and give this money to you, which is known as seed capital. Then once you have started the startup, you have initiated it, then the next type of investor comes, that is called angel investor. And angel investors are wealthy individuals who provide capital to help entrepreneurs and small businesses succeed. They are known as angels because they often invest in risky, unproven business ventures for which other sources of funds such as banks, loans, and formal venture capitals are not available. They come to you as an angel because you see, as an angel, when during your childhood, you all know परियों की कहानी सुनते थे and all that. The angel will come and will shower the best on you and all that. So they just come like that. That in case of your need, when you are trying to stand up but are limping, they will just simply hold your hand. They will come to your rescue. They will put in their investments and guide you also. The other term for them is entrepreneur in residence, that they would be a partner hand in glove with you as well as an investor in you. They would take equity in your business and they would guide you from time to time to let you stand and grow further. They are called angel investors or entrepreneur in residence, EIR. Unlike a venture capital firm that uses an investment fund, angels use their own net worth. You see, angels are those who have earned enough of money or who have grown big and earned so much of money that now they want to invest and let others grow further in their business to help them out. Angel investors usually give support to startups at the initial moments and when most investors are not prepared to back them. That is why they are known as angel investors. An angel investor, also known as a private investor, seed investor, or angel funder, is a high net worth individual who provides financial backing for small startups or entrepreneurs, typically in exchange for ownership equity in the company. Often angel investors are found among an entrepreneur's family and friends. Venture capitalist is a private equity investor who provides capital to companies with high growth potential in exchange for an entity's stake. This could be funding startup ventures or supporting small companies that have been deemed to have high growth potential or which have demonstrated high growth but do not have access to equities market. They generally take position in the board's management and have great influence in crucial decision making. They generally help the companies in which they have invested to attract good skills and in marketing as well. Private equity investors. Private equity is an alternate investment class and consists of capital that is not listed on a public exchange. Private equity is composed of funds and investors that directly invest in private companies or their engages in buyouts of public companies, resulting in the delisting of public equity. Private equity refers to investments in company shares that are not publicly listed. The investment capital is provided by individuals or firms with a high net worth. Generally, private equity firms take control of a public company which they will later take private by delisting company shares from all stock exchanges. Thank you.